and welcome back to yet another exciting week of the Lazy Money Game. This is the first episode of 2023, so first of all, Happy New Year. And since it is the first episode, it makes perfect sense to reflect upon 2022 and what has happened to my portfolio, since by all means, this has been a very interesting year to be an investor in. And before we dive into the details of the portfolio, let me just start by clarifying one thing, since I have seen a big trend on financial YouTubers here when we are at the end of the year. Then a lot of YouTubers are making videos about these are the top 3 growth stocks to buy in 2023. These are the top dividend stocks to buy. These are the best stocks to buy and hold forever. This is not what you're going to see from my side. I'm not trying to predict how the market will do. I'm interested in showing you what I'm doing, and then I'm trying to present my arguments for why I'm doing what I am doing. And the reason why I'm not making videos like those is due to the fact that I actually think that it is wrong. I know that there is a big demand for it, but I actually do not believe that that is what people actually need. Since if they're doing their own research and due diligence, well, then they don't need this shortcut saying, these are the top 3 stocks that you need to buy now. Why not just present what you are doing and then let people decide for themselves? In my mind, it is very similar to putting people on a strict diet to lose some weight. Well, sure, you might lose some weight, but if you aren't changing your habits and you haven't really understand what it is that you're doing, chances are when you're done, then you will actually be worse off than when you initially started. And that is why I think it is wrong to make these top 3 or top 10 or what you absolutely must buy now. So let me instead turn the attention towards my portfolio. If we start by focusing on the short term, namely the week, well, then we start by seeing that there was a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. If we go to the portfolio values tab, you can see that I'm up $800. So small movements in the big picture. If we instead focusing on the long term, well, how has my portfolio been performing over the year? How many of my goals have I actually achieved? So a good way to answer this question would be to go back and look at episode 96, since there I talked about my expectations for 2022. Back then, I explained that I hope to achieve $5,000 in yearly income, $1,400 in quarterly, $6,000 in yearly, and $1,600 in quarterly income, and saying that it might be stretching it a bit too far to reach the $7,000 mark in yearly income, since it would require too much investment based on what I'm capable of saving and actually investing into the portfolio. So let's take a look at the portfolio and see how many of these goals I have actually realized in 2022. So now that we are looking at the goals tab today, how did it actually go? Well, we can see that I have achieved goal number 35 of $5,000 in quarterly dividend. I also hit the $1,400 mark, but already on goal number 38, I failed. I haven't achieved $6,000 in yearly income. I have also not hit goal number 39 of $1,600 in quarterly dividends. But on the other hand, you can say I have achieved goal number 44 and goal number 47. So I achieved 2 different goals compared to what I actually expected for the year. And this is due to the fact that I saw an opportunity during 2022, which I have no knowledge about would come up during 2022, namely that I have invested a lot into Activision Blizzard based on this potential takeover from Microsoft. And that can explain why I haven't achieved the yearly and the quarterly goal. And at the same time, when I have sold out of store capital, that was a major dividend contributor in my portfolio. So those 2 alone can actually explain why it didn't go as I planned. And if we go back to the portfolio values tab here and scroll down just a bit, then I put in my calculations for how much I actually managed to invest during 2022. So during 2022, I have invested a little more than $26,000, giving me a monthly investment of a little more than $2,100. So I am still significantly above my target of investing $1,500 on average every single month. So it's not due to the fact that I haven't invested. As I have just explained, there were two major factors, namely that I have made a significant investment into Activision Blizzard and that I have sold out of Store Capital, which was my biggest dividend contributor. So the natural question to ask is, of course, now, what would I expect to achieve during 2023? So in order to answer this question, I think it is extremely important that we go back and look at my overview arc here. Since when you're looking at my holding in Activision Blizzard, which is my biggest holding, I have invested a little more than $42,000 into this position. So whether or not this all cash transaction from Microsoft goes through, that significantly impacts my portfolio, since if the deal goes through, then I will have $52,000 to invest, which is twice the amount of what I was capable of saving during 2022. So that is why I can't stress enough that my result in 2023 will be significantly affected on this particular deal. If we then for a brief moment go into my dividend sheet, then you can see here for December I have received $339 in dividends. So the last dividends which I expect to receive is from Lockheed Martin and from Brookfield Asset Management. The reason why I phrase it this way is due to the fact that they have payout date on the 30th of December, but I have not yet received them into my account, but I have calculated them in here just to make an end of year review. So as you can see here, my year-to-date dividend received ends on $5,658, which is roughly $1,300 more than the year before. This is roughly a 30% increase in my cash flow stream. So needless to say, I am extremely happy about this, but this once again shows you that this is a turtle race. You're not building a fortune within a year or two. This takes decades to build. Now I have explained my reasons for why it's actually quite hard to come up with a good estimate of how many goals I can expect to achieve during 2023. If I just have to put a little more numbers to it, if we scroll to the right here, well, if I'm capable of investing the same in 2023 as I have done in 2022, then I should realistically expect to add a little more than $750 in extra dividends. And with the current estimated dividends of $5,300, well, then I should be capable of surpassing the $6,000 mark, since my portfolio is expected to grow its dividends by itself. And at the same time here, if the deal of Activision Blizzard goes through, well, then I can add an additional $1,500. Then I need to subtract the $250 which I'm currently receiving from Activision Blizzard, giving me a total of roughly $2,000. So somewhere in the range between $750 and just over $2,000 is what I should expect to add in additional dividend income. So if we go back to the goals tab here, adding $750, that would mean that I should hit the $6,000 mark. So hopefully 2023 will actually be the year, since that is already 1 year delayed. At the same time, $1,600, well, maybe that's achievable. And then you can say $7,000 per year, $1,800 quarterly, $2,000 quarterly. That is only going to happen if the Microsoft deal is going through. And finally, we can go to the forecast tab, since we have finalized December. And unfortunately, it still does not look great if we scroll all the way down to this linear forecast, since even in April of 2044, I'm not even on $3,000, and I expect to have $4,000 in monthly dividend income in order to be financially independent. So based on this linear forecast, I'm not even there 20 years from now. But then the important thing to remember here is this is a very simple linear forecast. At some point, this is not going to grow linearly anymore. Then it starts to become more exponentially. So I'm still pretty confident that I will hit the $4,000 mark within less than 20 years. So this was a lot about what has happened in 2022 and some of my expectations for 2023. And if we go back to the overview arc here, notice here that I still haven't said anything about how I expect the stock market to perform, and that is actually not by coincidence. It is due to the fact that I say I simply have no clue, so why should I try and come with a prediction where the stock market will be a year from now? That is not my game. So what can you expect instead from me? Well, you can expect that I continue to do what I have been doing for the last 2 years. I will try to buy great businesses at attractive valuations whenever I think that is possible, no matter what the market is doing. And as you can see from the screen here now, sometimes I do it well, and sometimes I definitely are paying too much, at least in the short term, since we can still highlight a company like Citigroup or Verizon Communications, where I am down around 30%. And even my latest acquisition into Brookfield Asset Management and Brookfield Corporation, well, that is not doing particularly well either currently. And one thing I want to highlight here with Brookfield Asset Management, since now I have received a reply from the Danish taxation authorities, my assumption was actually correct. Whenever you have a corporate action and you see a spin-off like we saw, well, the value which is spun off in a new corporation, that is the purchase value that you can use. So the way that I have put 20% of the price that I paid into Brookfield Asset Management, well, that is actually the correct way of doing it. I was assuming that this would be the case, but at least it is nice to get someone from the Danish tax authorities to verify that for me as well. So this means that I can actually do the same calculations for Organon, since that was a spin-off from Merck. So let me head over to my Excel spreadsheet and show you how I have done that calculation as well. So how do I actually calculate the updated purchase value for both my Merck share and for Organon? Well, from my Google spreadsheet, you could see that for every 10 shares of Merck, I have 1 share in Organon. So what I have to do now is, I know my old purchasing price. Now I have to put the fraction that I can use to find the percentages of the original holding and do the distribution. So for every 10 shares of Merck, I get 1 share in Organon, meaning the fraction I have to use here is 1/11 for the new Organon holding and 10 out of 11 for my new Merck holding. Meaning the purchasing price for Merck, I have to lower that to 13,941, and my purchase price of Organon should be 1,394. So now you can see here that the total adds up, both in nominal terms and in percentage terms. So these are the new values which I will have to reflect in my Google Sheet now that I have received that confirmation from tax. So when you're looking at my updated Google Sheet here for Merck and Organon, you can of course see that this severely impacted the percentage change in these two holdings, since my Merck holding is gone from 45% up to roughly 59%. And at the same time, my Organon change is severely down, since before I just had the invested value at $1, so the percentage change was absolutely ridiculous. And now you can see it's actually down close to 60% instead. So now it is fully updated after I have received that confirmation from tax, which was actually pretty nice to get. So this actually had the small impact on the cost of my portfolio, since I have now removed $1 invested into Organon, since that was the value I had before. So if we head over to the portfolio values tab, just to have a look at the full year here, since as you saw earlier, I have invested a little more than $26,000. So how much has my portfolio actually increased in value over 2022? So the value increase is $51,000. That is the value at the end of week 42 minus the value at the beginning of week 1 of 2022. So the value increase of $51,000 minus the cost, that gives me an actual gain of $25,000. And that translates into a percentage gain of a little more than 11% for the full year. Not bad for a small-time investor, especially when you're thinking about the S&P 500, which is down 19.95% for the full year. So beating the S&P 500 with a little more than 30%, I am of course very pleased with that result, and I do not expect to be able to beat the S&P 500 by this margin every year. That would be absolutely bonkers. And as always, remember to be very critical of the numbers which you are presented with, since, I could have a severe interest in only showing you what my portfolio has been doing within this year and then comparing it to the S&P 500 and claim that now I am the next Warren Buffett since I have beaten the market by more than 30% within a single year. That doesn't really say anything. You need to look at a much longer time horizon. So let's change the picture here and see how much that actually changed the result. So if we look at a 5-year chart instead here, I started my portfolio back in the 3rd week of January. So if we just take the price on the 10th of January for the S&P 500, we can see that it was a little more than 3,200, and today it is a little more than 3,800, meaning an increase of 17.5%. If you, in that light, look at my portfolio and see that I'm only up a little more than 23%, sure, I'm still beating the market, but nowhere near beating it by 30%. And just to add one more caveat here, currently my portfolio consists of 18 different holdings, which is nothing compared to 500 different holdings in the S&P 500. So from a risk managed perspective, you would say that my portfolio is much more risky. And if you don't know anything about the businesses in my portfolio, then by all means stay away and buy a passive index fund, because chances are you will sell out when you are seeing a company being down 70%, which we have seen time and time again in my portfolio, if you have no knowledge about what the company is actually doing. If you're just buying something because some random YouTuber has done it, well, by all means, do yourself a favor and don't do that. If we then continue to questions from the audience, then I have received a question that goes like this. Hey LMG, just rewatched your video on purchasing VG. I'm very puzzled at today's payout ratio. It's exceeding your guidelines. Today's payout ratio is almost 140%. How does that affect the moat, and shouldn't you sell VG? The reason I ask is that VG is on my watch list, but still on the watch list due to the high payout ratio. Yours truly. So first of all, thank you very much for that excellent question. If we go to Seeking Alpha and look up VG, look at dividends and then scroll down here, then surely you are correct. Currently their payout ratio is around 140%. And surely that is a red flag whenever the payout ratio is above 100%. Keep in mind that VG is a REIT, meaning they are forced to pay out 90% of their taxable profit in order to keep this status. And that means that it is more common for REITs from time to time to have a payout ratio of above 100%. What I really like from your question is that this company currently is only on your watch list since you're seeing this red flag. But whether or not you should invest in VG, I cannot answer that question. But at least I'm happy to see that you're doing the research and due diligence into the company and saying, oh, I'm seeing a red flag, hence I can currently not invest in them. So the question is, do you believe in their business model in the long term, and do you only think that what they are challenged with currently are only short-term issues? And if I have to address the second question you had, if the payout ratio of above 100% is affecting the moat, I wouldn't say that it is directly affecting the moat, at least not if the payout ratio only stays above 100% for a short period of time, since the moat is the business model, meaning are they capable of doing what they are doing, and do they have a competitive advantage? Sure, you can say at some point if the payout ratio stays above 100%, then their business model might be affected, since they will have to continue to borrow more money just to pay out a dividend which their business can currently not support. But I wouldn't say in the short term that a high payout ratio above 100% is directly affecting the business model. But sure, if we are looking at a more long term, then you might have a point. So that actually sums it up for yet another exciting week of the Lazy Money Game. If you have enjoyed the content, then please consider leaving a like or subscribing to the channel. Who knows, maybe you will continue to see more market-beating returns. It is no guarantee, but no matter what happens, I will continue to provide updates for my portfolio. And until I see you next time, bye!